because we've had 6 rate increases since March. You're really tied to the residential market. You coach, mentor, and teach a lot of people. What are you seeing right now due to these increases?
Well, everybody is talking about and worried about, and many are predicting a big real estate crash. I don't see it. And I might be eating my hat, okay? I think there will be some continued softening. I think people have got to dissect that discussion between linear, cyclical, and hybrid markets. When you segment by price, by geography, and all of that stuff, I think the necessity level housing is going to fare pretty well through this. And remember, at the end of the day, it's always the question of compared to what. It's not just the question about what is real estate going to do, but the question is, if you're an investor, what other option do you have for your money, right? There's an acronym in the investing world, TINA, T-I-N-A, and it stands for there is no alternative. And so when you look at investing, you always have an opportunity cost. If you close one door, you open another. If you open one, you close another. And that's the decision investors always have to make. What is the highest and best use for my money? Where can I get the return? And if you look at properties that are pretty conservatively performed right now with vacancy rates, repair costs, maintenance costs, management fees, overall, because income property is a multidimensional asset and you're not just earning your return one or two ways, they'll perform with leverage, of course, over 20% annually. So I always say, even if it only goes half as well as expected, 10%. And what are you going to do? Lose money in the stock market and cryptocurrency? I don't know. What is the alternative? That's always the question.
Let's unpack a little bit of that, because I know we've had you on before and you talk about the cyclical, the hybrid, and the linear markets. And you were saying that, which is going to be cool to talk to you about, because a lot of people are saying that everything's going to crash. I also believe that real estate's going to take a severe adjustment. But what you're saying is you invest in these linear markets.
Yes.
So can you explain that real quick?
In a country as large and diverse as the United States, there's no such thing as a national housing market, okay? There are really just local markets. And the old saying in real estate that we've all heard is all real estate is local, right? And that is true. And so we have almost 400 what's called MSAs, Metropolitan Statistical Areas. We have over 3,100 counties in the U.S. We have over 9,000 cities in the U.S. All of these markets act somewhat differently. Of course, they're related for sure. And I divide them into 3 basic types. The linear markets, these are these boring markets that are inexpensive. They're characterized by always low land value and high improvement value. People have to remember, when they buy a property, they're really buying 2 things. They're buying the land, and they're buying the improvement sitting on the land, the house or the apartment complex, right? Or whatever office building, doesn't matter. And so when you have low land value, that's where the froth is. And so when things are going up and the market is going crazy, land values skyrocket, usually buoyed by high affordability and low interest rates, right? And good incomes in comparison. But when they're going down, land values do soften. They do soften a lot. The improvement value doesn't soften that much. Of course, in a down market and during the Great Recession or the global financial crisis, whatever you want to call it, we did see a lot of deals that were below the cost of construction. But the construction materials, and you both know this all too well with your business, they are commodities traded globally, not attached to any one currency, and needed by every human on earth, because everybody needs food, clothing, and shelter. And so these materials set something of a floor on values and how much they can drop. So what I say is buy in these linear markets where land is cheap and improvement cost as a ratio is high. It's a bigger part of the equation, and that helps offset risk.
Okay, I get that. I get that.
So a cyclical market, on the other hand, is the complete opposite, right? That's like where I grew up in Los Angeles, California, okay? In a cyclical market, you have really high land values, and as a ratio, low improvement cost to land. And when things are going up, it goes up like crazy. And when things are going down, it plummets fast.
So one of the things that I'm finding, and we do investment committees every week, and our acquisition guys are out there, our analysts are looking at deals. And, if you look at an NOI, let's say a year ago or 6 months ago or 1 month ago, it is what it is.
Yep.
The big difference is the cost of debt.
Yeah.
And so when debt goes up, cash flow goes down. Therefore, the cash on cash or the yield goes down. And so, that's all across the entire nation. So cyclical or linear, right? So the cost of debt for that same house is going up, let's say.
Oh, yeah.
So isn't the cash flow going down at the same time?
Oh, yeah. I mean, cap rate compression, it's constricted, no question about it. That debt, I mean, look, real estate is a credit-based asset class.
Yeah.
So when the cost of debt goes up, the deal looks different, no question about it. It's more susceptible in those cyclical markets, and hybrid is the third kind, just in between the two.
Sure.
Okay. If you look around the world, most of the world is a linear market, like the middle of the country. And the coast are the cyclical markets. Those are the markets that get all the attention in the news media, are the cyclical markets, because they're newsworthy. There's something going on. They're going up, they're going down. The boring linear markets don't get that much attention. But yes, the debt is a national or even global thing, right?
And I was going to ask you, Jason, if it's a linear market is different than a cyclical market, you still have to, though, factor in what people can afford month to month with the interest rate, right? I mean, the interest rate has to affect even a linear market.
Of course. It affects every market, no question.
And that's what I was talking about with your brother.
Yeah.
Because he's solving to his monthly payment.
Yeah.
We have a very good friend, I'm from Seattle, that was, let's say, his home. Things in Seattle have gotten really pricey, but he bought a home in the 500s, and now it's like right around $1 million.
Yeah.
Okay, well, he's in let's call it a mid 3% loan, and he wants to move, but he's not moving because if he buys the exact same $1 million home, and it's 6 or 7%, his payment jumps so high.
Yeah.
So. One of the things we were talking about in this chart is the number of mortgages by interest rate. So there's a lot of people that are, equity rich.
Right.
And, it's trapped because in that particular case, he's like, I'm not going to move because I get the exact same house and my payment goes way up.
Yeah.
Why would I move?
I'm so glad you mentioned that. This chart, I have long said on my podcast and YouTube, I've been talking about how about 25% of the mortgages in the country, the existing mortgages out there, right? There's about 100 and, I don't know, depends who you ask, but there's around 140 million housing units that are owned, right? And about 25% of those have mortgages below 3%. I mean, think about that. Why would you ever want to give that up?
Right.
People will beg, borrow, and steal to protect that mortgage asset. And here's the funny thing. You can have something that is worth more to you than it is to someone else. This is a really important concept that is hard for people to get their head around sometimes. And so that house with that cheap mortgage may be more valuable to the person already owning it than it is to the market that sets a new price on it.
It's probably
because they have to pay 7%.
It's cheaper than rent. In a lot of cases, that mortgage might be cheaper than rent.
Yeah.
So that's why I'm saying those people are going to be stuck there for a while.
That's the poison pill the Fed, the dysfunctional central planners that run our economy, have put into the market. And guess what? That poison pill has a 28-year timeline left on it. And that will constrict housing inventory for decades to come, because I don't know that we'll ever see these kind of low rates, but people have 28 years left on those mortgages at 3%.
Jason's got a big event coming up in Scottsdale in January.
Late January, last weekend of January.
Chat about that real quick. Yeah, it's going to be cool. You got Tom Wheelwright speaking, you got George speaking, I'm speaking, you got a bunch of people coming.
Yeah, Ken McElroy is speaking.
It's going to be fun.
Yeah, no, it's going to be a great event. It'll be a lot of fun. 2.5 days, last weekend of January, Empowered Investor Live.